Breaking up is hard to do, but when it comes to your wireless carrier, you should have left a while ago. You're over the big three carriers. You deserve better. Xfinity Mobile. Now you can get unlimited with 5G included for just $30 a month on the nation's fastest, most reliable network. So break free from the big three and save with Xfinity Mobile.
Take the savings challenge at xfinitymobile.com/mysavings to see how much you can save when you get Xfinity Mobile and Internet together. Reduced speeds at 20 gigabytes per line. Most reliable based on Root Metrics US report. Results vary, not an endorsement.
Welcome to the Money and Investing Show. This space is all about managing money and kickstarting you into the world of investing and finance. A series of bite-sized episodes designed to simplify and equip you with the tools on how to get you started, along with some tips and tricks for those already investing. Stay tuned for today's episode with your host, Dale.
Hey everyone, welcome back to the Money and Investing Show. Great to have you with us. So we're now in 9 episodes deep, and by now I'm hoping that you have a pretty good understanding of what the share market is, how to invest, how to go out and find and research companies, and how to buy and sell them through your online broker. So as I mention each week, if you have any questions you would like answered, please send me an email at info@capitalmediagrp.com. I'd love to hear from you guys, and if there's any questions, I can hopefully answer those for you. So in today's episode, we are going to talk all about building out a portfolio. To kick this episode off, I'll get straight into what a portfolio is. And essentially the way to think about a portfolio is a collection of financial investments or assets that you might own. So think about things like stocks, bonds, cash, potentially other things like real estate, gold. Then there's things like collector's items. So you've got paintings or watches, or even fine wines come under that. Or you might even look at things like cryptocurrency if you are one of those people that believe that they are an asset. So for the purpose of today's episode, I'm going to talk about a portfolio in a purely stock portfolio sense. But as you can tell, there is plenty of different ways you can build out an investment portfolio. And as you're probably sick of me saying in most episodes, but the portfolio that you have will largely be driven by your goals, your time horizons, and any risk tolerance that you might have. First up, one of the key factors to portfolio management is all about diversification. So diversification, put really simply, is a form of saying don't put all your eggs in one basket. And by diversifying your investments, the goal is to really reduce your exposure to risk in any one category. By investing in different assets, you are looking to really maximize your upside while protecting your downside from any one event. So think about different asset classes. It could be different countries and even different industries. They would all react really differently to certain events. And so by having exposure to these separate areas, you're really setting out to protect yourself. The idea is that while some assets might be falling, others will be rising, and diversification protects you against that really sharp volatility. So as an example, if we're going to talk a stock-only portfolio, some of the things you would look to do is to buy shares across different sectors. It could be financials, resources, maybe some tech and healthcare, just to name a few examples. And you would possibly also look at different countries to avoid being tied to any one economy. And if we are thinking still about just a stock portfolio, then the next question that comes is, how many shares do you need to be truly diversified? And there's no real one answer to this question. So some people will tell you that you need only 5 or 6. Others will tell you that you need upwards of 50, and I've seen some portfolio managers talk about up to 100. The general consensus lands somewhere around 20 to 30 different shares within a portfolio. However, if you're listening to this and you've just started out, you might not have the spare cash lying around to just dive in and buy 20 or 30 different shares. And I think the easiest way to find diversification is by just buying an ETF that tracks a collection of stocks. And we've spoken about ETFs in plenty of episodes, but by doing this, you instantly get exposure to a really large collection of diversified stocks. So it's almost like buying a diversified portfolio in itself. When I think about my own portfolio, I find myself that trying to hold too many stocks becomes too much work to keep track of each individual company. I know at one point, I think I got up to about 30 different holdings, and I wasn't able to keep up with all the company reports and reading. It's not my full-time job. I do this after hours and on the weekends. So to try and keep on top of what 30 companies were up to, I found quite difficult. So now I like to keep maybe around 8 to 10 companies I really like and just add to my positions rather than buying new companies. And I think this has allowed me really to keep a greater handle on what each company are doing and how they're tracking and performing at any given time. So if you do want to just jump straight in and start buying individual shares instead of going the ETF path, that's also fine, but don't get too bogged down on diversification until you start to build up a few more holdings. Most people, when starting out, start small and really just grow from there. And as you add more investments, you can look to diversify away from your original investment. And before you know it, your portfolio will be full of all these different stocks. Coming back to myself personally, I know that my portfolio is made up now of about 30% ETFs. But at one point when I was starting out, I know it was like 80 or 90% ETFs because I just found them a really easy way to get started. And while I haven't actually sold off any of those ETFs from the beginning, I have just purchased into more shares, and that's basically brought that portfolio weighting down in ETFs. And while some of my growth stock investments have had large swings up and down, the ETFs have really kept my portfolio steady, and they've really helped me to avoid some of the risks that investing in a single company might bring. And again, it's one of those things I spoke about in an earlier episode. It's really about how would you sleep at night. And if you've got a lot of your money tied up in some really volatile stocks, there's going to be a couple of days and nights where you're just sweating because the company has moved so much in a really short period of time. So to move on from diversification, the next thing we're going to start to look at is portfolio weightings. And what I mean by that is what percentage or portion of each share takes up in your total portfolio. So think of this as a pie. And it could be either a graph or a physical pie. And each slice of that pie is one of your companies or your shares. So the larger that slice, the more exposure you have towards that company if something was to happen. And that goes both ways, up and down. In the same way we diversify against risk by investing, in different industries and countries, we can also protect ourselves from any downside pressure by ensuring that we aren't overexposed to any one company. So I know there's some people or fund managers out there that like to say that no one share or company should be more than 5% of your total holdings. I personally work to about 15% myself, but as I said a little bit earlier, I really don't look to hold as many companies as some others might do. And then you might be thinking, so how do you manage all of this? So a lot of fund managers look to actively sell down their holdings to ensure that this always remains at their desired sort of weightings. So, if one company grew to say 7% of their holdings, they would actively sell down enough to be back at 5%. I like to take a slightly different approach where I like to really let my winners run. And so rather than sell them down if they go over my sort of 15% target, I will just no longer add to that position anymore. So next time I add money into my portfolio, it will go into another company, and that will gradually balance my weightings back out, assuming that winner doesn't just keep on winning and winning, and in which case that's not that bad a thing anyway, is it? And again, if you're just starting out, don't worry too much if you've only got, one or two stocks and they're both at 50%. This will gradually come down as you look to broaden your investments. So there are a few things to look for when looking to really build out a share portfolio. A really great tool I found helpful when trying to look at how to build out portfolios and understand how everything worked was a website I came across called Strawman, and I'll pop the link in the bio to the show description. But essentially what you can do is go onto this website and create a free account that allows you to build a mock portfolio and trade companies. And there's plenty of other websites around that do this type of thing. I just found this website really helpful. So, you build out a portfolio, and then this tracks the market, and you can see how your investments would play out if you had have invested. It's a really great tool to understand how a portfolio might be constructed and to see how your diversification might work in action. I also found there's a really great community on this website that are sharing ideas and helping each other out, sharing different points of view on companies, and I just think it's well worth a look if you get a spare time. And that really wraps us up for today's episode. Following this, I'd really encourage you to start to think about ways that you can diversify with your own portfolio, how you manage the weightings inside it, and how you really diversify against different industries and different risks that might appear that you can protect yourself from. And as always, if you're enjoying these episodes, please hit that subscribe button or leave me a review. I'd love to sort of hear what you guys think of the show. And as I said at the top, if there's anything further you would like me to touch on, feel free to email me at info@capitalmediagrp.com. So I'll finish up today with a quote from Peter Lynch, who is a really well-known investor on Wall Street, has written a bunch of really great books that are worth a look. But the quote goes, "Know what you own and know why you own it." Doing your homework before making a decision. And then once you've made the decision, you can then go back and reevaluate your portfolio on a really timely basis. I think it goes to that point that I was speaking about earlier around me having a smaller portfolio percentage than other sort of people. And it's really about ensuring that I can know what's in that portfolio and keep a track of it to the best of my ability. So, don't get too bogged down sometimes on really just over diversifying. Make sure you really understand what you've got and why you have it in that portfolio. I hope today's episode's helped, guys. Thanks and have a great week.
Please remember, the information and opinions provided in this podcast is general advice only and does not constitute financial advice. This podcast was created without knowing individuals' needs, financial situations, or investment objectives. The host of this show may hold positions in the companies discussed. Please remember, before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.
Lunch in the park? Check. Hand sanitizer? Check. Cancer screening? Done. We've all adapted to a new way of living. Keep your healthcare on schedule with Johns Hopkins Medicine, where your health and safety are our highest priorities. We're ready to care for you through virtual and in-person visits across Maryland and the greater Washington region. Your health, our experts, safely caring for you. Schedule your care now. Learn more at hopkinsmedicine.org/safe. Masks for family? Check. Garden cleanup? Check. Schedule back pain visit? Done. We've all adapted to a new way of living. Keep your healthcare on schedule with Johns Hopkins Medicine, where your health and safety are our highest priorities. We're ready to care for you through virtual and in-person visits across Maryland and the greater Washington region. Your health, our experts, safely caring for you. Schedule your care now. Learn more at hopkinsmedicine.org/safe.